Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name is John Addis. I'm the editor and founder of Intelligent Investor. And this morning on Stocktake, we are talking about China, uninvestable China. The country has gone through an incredible transformation over the past 50 years, perhaps the greatest transformation in economic history. It's gone from being an agrarian society where land was collectively owned to producing some of the most impressive and largest companies on the planet, companies like Baidu, Alibaba, and Tencent. Today, we're going to talk about these companies. We're going to talk about what makes China uninvestable now, because that is the general theme of the past 4 or 5 years. Let's start with Nick. Nick, you produced a story this week on China and why it might be an opportunity for speculation. Tell us why China is uninvestable now.
Well, I think the reason, I guess, most sort of professional fund managers find it uninvestable is that there's been this massive crackdown on capitalism and wealth within China. So the goal of Xi Jinping over the last couple of years has been common prosperity, and that seems to go directly against goals of the past. So 40 years ago, the goal of Deng was it's glorious to get rich. Or something along those lines. So there's been a huge change in the government's approach to the Chinese economy over the last 4 to 5 years, and that's really scared fund managers. So you can see that with just investor flows. So people have been pulling money out of China. Short interest has increased, and now these companies are some of the cheapest on earth. So if you look at a company that you mentioned at the start, like Alibaba, it's at about 10 times earnings, has plenty of cash, and is now returning cash to shareholders. So on one hand, the sentiment and the prevailing wisdom is this is uninvestable. But on the other, there is some, I think, opportunities, and the sentiment's gone so far the other way that it might be the right time to start looking at China.
Gaurav, do you think there's a little bit more to the argument than just that they've cracked down on capitalism? Is there something about the structural reasons in China's economy where you can't really see it in the same way you might do the US or Europe?
Well, let's have a look at the Chinese development model. I mean, in many ways, it's textbook. It starts with land reform. It then moves from land reform to migration. You have this huge pool of people moving from the rural areas to urban areas, and then you get special economic zones set up where factories and technology is incubated, and then those zones kind of grow into their own, and you end up building export sectors which compete with the world, and end up creating a wealthy middle class, and then you finally end up with a sort of a perpetual consumer society. That sort of pattern is exactly what happened with Singapore, with Japan, with South Korea, Vietnam, Thailand. Most of Asia has followed that same development model. So in some respect, China is no different to what's happened before. It's only on a much larger scale. But in all those other examples, economic liberalization was joined with political liberalization, and that's where China's unique. And that's why we look at it more carefully, I would say. And I would say that's why the investment community views it with more skepticism than, say, a South Korean business, a Japanese business, or indeed even one from Thailand. And that's not crazy. There are good reasons for that, because it is different in that respect. I mean, I'm going to push back a little on your claim, John, that China has world-class companies. They are large companies, but let's not forget that Tencent, Baidu, even Alibaba exists because American companies were completely banned from the Chinese domestic economy. Mm-hmm. And these companies don't operate anywhere else in the world. You don't go to Google, for example, is dominant in many countries around the world. Mm-hmm. Facebook is dominant in every country around the world except China. No one uses WeChat outside China except Chinese citizens. Mm-hmm. So there is, these are large companies that make lots of money, but they have been the benefits of the benefactors of really strict political control. And in the absence of that control, I'm still not sure they would be all that successful. If you rewind 20 years, if Google was able to compete with those companies, would they exist as they do today? We don't know, but it's something worth thinking about.
In the case of Baidu, I think that's almost certainly the case.
So there's good reasons why people are fearful of China and why they're skeptical and why it should attract low multiples. Nick, you'd remember when the CEO of the biggest company in China, Alibaba, just disappeared for months at a time. We woke up one morning to find an entire industry just closed down overnight. Rio Tinto sent a team to negotiate iron ore prices. That team was put in jail indefinitely for about 3 years. Mm-hmm. And this is not Japan or South Korea or America or Spain, right? There is something unique about China and something a little sinister about China. And that's why investors treat it with so much caution and why low multiples are I think, well-deserved across the Chinese market.
I'd also add to that in that China, whilst it has probably pulled somewhere over 500 million people out of deep and sort of crushing poverty and has been very successful at doing it, it's still yet to escape what is called the middle income trap. Average Chinese salaries now are about $17,000 a year. That's still nowhere close to what Korea and Japan do. So the idea that this is a developed economy is still there's still a big question mark over that, I think. And you can see that in the structure of the Chinese economy, which is very much export driven. And over the past 10 years, it's tried to develop a more consumer-led economy, which is what developed economies tend to do. Hasn't really succeeded in it. It's still an export-led economy. So I think when you consider that, when you consider the income levels, when you consider the nature of the government, its interference in the operation of capitalism, it is an entirely different situation to any other country that we would consider investing in. But Nick, you're still quite excited about it, so tell us why.
Yeah, I think just to push back on a little bit of what Gaurav was saying about these companies aren't actually that remarkable. That has been the case for, I'd say, the last sort of decade, or maybe 5 years ago and the last decade before that. But you are now starting to see some more global successes come out of China. So Temu was completely shocked, sort of the retail market.
Yeah, no, I agree with that.
TikTok, the Americans talked about banning TikTok because it was going to take over Facebook, essentially, and they're still worried about TikTok. You've had Shein, you've had BYD in the Australian car market that you've spoken about, Gaurav, and they, like the Chinese, I think now export the most cars in the world. So that was something they couldn't do. They couldn't compete with the Germans or the Japanese for years on that, and now they seem to be, almost head and shoulders above them. So I think
Huawei is another example, which has dominated, until it was banned in the West, it has dominated telecoms.
Yeah. Yes. So I think this narrative about that China is, 10 years behind the technology in the West is just, I think it's wrong. And you've seen that, more recently with DeepSeek. Who could have thought the Chinese could have created an AI model that's, I guess, better than, in some respects, than the ChatGPTs or the Anthropic Claude model. Without using the same sort of semiconductors, advanced semiconductors that they had access to, and reportedly spending much less money, though that's, that can be probably debated. So I think this narrative about China that it's still, sort of stuck in this export mindset, and that they don't have any advanced technology doesn't fly anymore. And then the second point about why I think China is looking interesting is just because of the sentiment. It is the most hated market on earth by far. Any professional fund manager that approaches China sort of thinks about it from a career risk. So there's so much career risk getting an investment in China wrong. Why would you take it? You're just better off investing in America, particularly after big tech's been going up 20 or 30% a year. So from a sentiment point of view, I don't think it can get any worse. And then the Chinese government's also made some, it's sort of started to acknowledge that they went too far on the crackdown without saying that. So they've started to approve video games again. They've directed their state pension funds and their insurers to invest in domestic stocks again. They've rolled out a lending facility at dirt cheap interest rate of 1.75% for companies to borrow from banks and buy back stocks. And I think this is their goal here is to really increase consumer confidence through a wealth effect. But it also says, I think, that they went too far in sort of prosecuting wealth, and that they need a well-functioning sort of economy and also stock market and property market for everyone to prosper. And I think that's been some of the changes that have been probably missed just because the sentiment's been so negative.
Yeah, and I accept that. Over recent years, there has been much better quality and genuinely disruptive, innovative business coming out of China, but it hasn't come from the giants. I think the examples you mentioned, Shein is a terrifying competitor for anyone. Wesfarmers closed down Catch of the Day. Thanks for that, Catch of the Day, because of Temu and Shein and how unreachably cheap those platforms are. And I think there's a lot more disruption to come. I don't think Australian retail is concerned enough about Shein in particular. But then BYD is stunning. If you look at the Korean or Japanese car industries at a similar point in their evolution, China's probably 15 years ahead of where those guys were at this point, and really impressive products coming out of BYD. So yeah, I accept that things have actually moved on and changed. And the innovation isn't coming from those really big guys, although there is innovation there as well. But the scariest competitors are these new little firms that have kind of popped up over the last 5 years.
That's true of the West, though, too. You often get most innovation comes from smaller competitors where there isn't a legacy business to hang on to. So I think that is a similarity between the West and China. I do accept your point, though, about the entrepreneurialism. I know a few Asian fund managers, and whenever they talk about Chinese entrepreneurs, their eyes just light up. They think the Western entrepreneurs are just lazy, overeducated, unadventurous, smug people who just will not ever win a fight with a Chinese entrepreneur, who seem to be just relentlessly ambitious and absolutely obsessed. They see Chinese entrepreneurs as a class above Western entrepreneurs, and I think we're maybe seeing that in some of the companies you mentioned there, Nick. They do seem to be at a level where they can compete with the West. So I suppose the question is where can they get more of them? Now, in your story, Nick, you published a chart on VC-backed Chinese companies over the past 15 years. It doesn't look good for China, does it?
It does not. It does not. Yeah. So the chart essentially shows that venture capital backed companies founded in 2018 was around 50,000, which was the peak, and by last year that had fallen to 500. Wow. It's just a massive decrease, and this is that crackdown that we've spoken about on wealth and entrepreneurism that's flowed throughout the economy over the last 5 years. And that's a real threat for China. And most people expected China to just come out of the COVID lockdowns and resume growth at sort of, mid to high single digits, but that has certainly not happened. And this is one reason why the crackdowns have had a really large impact. But I think there is, again, they're never going to state it in a press release, but I think there's acknowledgement that it's gone too far now. And there's been, stimulus is being rolled out. There's been a lot more support around their largest companies. And you've got to remember too, like the Alibabas and the Tencents of the world, maybe they aren't the ones that are bringing this disruptive tech to market as much as they previously were, but they are usually the ones funding it. They have massive venture capital arms, each of them, and they have huge stakes in a lot of these firms. So even Temu, I think, is Pinduoduo. That's the company behind Temu. And I'm pretty sure Tencent owns a 10 or 20% stake in that business and has funded it throughout the history. So, yeah, so they're still very involved, those firms, in that whole sort of, tech, or the Silicon Valley version of China. But yeah.
I do agree with you about the fund manager neglect. Even if you aren't, even if you're a bit skeptical about Chinese firms the way I am, I still think I agree with you on the opportunity in China. There is just overwhelming negativity, and everyone. I think what really helps is when you have a glaring example that everyone is terrified of, and that's Platinum. Platinum for the last 10 years has backed Chinese companies and has almost destroyed their business from their stubborn holdings of Chinese stocks. And no fund manager wants to be Platinum in that regard. So there's a real reluctance to invest in China, and I think that is an opportunity. So I do agree that although we may have different levels of enthusiasm for Chinese business, I do think Chinese investments are really attractive at the moment, and that's one place I think. You and I have both been talking in the office about buying something in China. I think it's pretty interesting. So how do we do that?
Well, that's right. Let's talk about that. I should confess that I do own 2 Chinese stocks. I was a little bit early. I bought them about 5 years ago, I think, Alibaba and Baidu. They were really cheap then, and they're even cheaper now. And I want to take members back to, or listeners back to 2012, when we produced a report called the Cummings China Crash. And I think this is important context if you're thinking about investing in China, because a property crash, well, Chinese growth has often been orientated towards infrastructure and property. And you may remember stories in the news about a decade ago about cities like Addis, which was built to house 1 million people and had 30,000 residents. There's so much money going into property, not just via state and local governments, but also individuals. We've seen that crash happen. We were 12 years too early. We've seen that crash happen.
I love that you called it early instead of wrong.
Yes, that's right. So the crash happened probably around June 2023, something like that. And just recently, we've now seen that the China Cities home price tracker has started to just increase slightly in 25 or 30 of the major cities there. So maybe that's turning around. The government are very much aware of how much property prices feed into the wealth effect in China. So they're probably doing something or thinking about doing something to push that along a bit, as well as the changes that you mentioned, Nick. Let's get into the companies now and talk about what kind of companies would you like to buy in China, and what is the best way of doing it?
Yeah, I think the best companies in China, I still think, are these big tech firms. They're by far the cheapest compared to any other country on earth, but also they're cheap relative to their own history. And for the first time in a long time, they started to actually return cash to shareholders. So a company like JD.com last year paid a 2% dividend and bought back 8% of its stock. Alibaba bought back 5% of its stock and has a $20 billion US buyback authorization in place for the coming 18 months, I believe. So the returns on capital are sort of changing with these big tech firms, and I think they're the clear most investable options, and they're also the most liquid. So you can buy them on most have ADRs on the New York Stock Exchange. Or
do you want to explain what ADRs are and tell what JD.com is as well?
Yes. So, start with JD.com. JD.com is sort of the second or third largest e-commerce retailer, so sort of behind Alibaba and behind Pinduoduo, now the company behind Temu. And they do have an ADR listed on the American Stock Exchange, which is just an American depository receipt, which pretty much just means you can buy that company outside of the Chinese stock market. So there's other companies. BHP's had sort of ADRs and other dual listings for years. I think they actually closed theirs a few years ago, BHP, but it's not an uncommon practice. So that's the direct investment option. Investing directly, as you've done, John.
can I just interrupt there and join the chorus and say that that's really important. The fact that these companies are paying dividends and buying back cash, even if you're suspicious of the accounting, and I am suspicious of the accounting, and I don't always believe the numbers coming out of China, but the fact that they're using real cash to buy stock and pay real dividends, that goes a long way towards relieving any suspicion you have, and that's really important. So I wouldn't be interested in the absence of that, but that's a huge development for me, and I think it's really important.
Yeah, it was certainly the biggest change for me as well. And then even the ETFs, you can see it too. So there's an ETF listed, I think it's an iShares ETF on the Australian Stock Exchange, and that's essentially tracks the 50 largest and most liquid Chinese firms. I think the ticker is IZZ, and that pays a 3% dividend now, and the management fees kind of okay. It's about 60 basis points, and that gives you access to all those tech firms that I spoke about. So the largest holdings there are Alibaba, Tencent, Xiaomi, and a Chinese bank as well. And so that gives you some pretty broad exposure, and you don't actually have to invest overseas. You can buy that on the ASX. And then I guess the last option is buying ASX-listed stocks that are linked to any Chinese recovery, and probably you're best to speak about that, Gaurav. I know you follow a lot of the miners.
Yeah, I'm not sure whether that is the best way. I mean, in the past, Chinese growth has been really investment-led, so they've been building things and consuming huge amounts of resources as they build things. But if the economy is going to succeed over time, it does have to stop building stuff and start relying on citizens to buy stuff, and that's probably going to be less building intensive, material intensive. So I think we've probably seen the best of the Chinese super cycle, and so I'm probably less enthused about commodities, I think, than I have been over the last decade. But that's not to say that they're going to fall off a cliff or anything. They're still at the moment, most miners are quite cheap, and I think the prices are more likely to rise than they are to fall. So any decent miner will probably do better as the Chinese growth accelerates.
Yeah, it's an important point too, I guess. The stimulus package you've seen roll out, I think it was in September, October last year, hasn't been as infrastructure focused.
It's very different. Yeah,
it's very different. Yeah, so that is a good point. Maybe that the old way of playing it through the miners or the commodity companies perhaps isn't the right way. Maybe you've got to try and find some consumer companies like a Treasury Wines or an A2 Milk that are listed here that could benefit from sort of Chinese consumption picking up and a wealth effect if the stock market were to perform again.
I'd also flip that around and note that there are much better quality Chinese domestic competitors now now being birthed. I think the A2 Milk has probably lost its brand advantage that it had. The days of it selling $80 tins of white powder are long gone and aren't going to return, because the brand equity has just fallen so much because domestic competitors have crushed it. Ditto Nike and Adidas. I don't think they have the pricing power they used to enjoy in China. KFC, likewise. Volkswagen, BMW, Mercedes, likewise. I just think you need to be really, really careful if you're investing in consumer products, expecting them to crack the Chinese market, because that domestic Chinese market is so much more competitive and higher quality than it was. And in fact, I'd be concerned about some local companies that are going to face Chinese-sourced competition.
Which might be Lovisa at some stage.
Which I think Lovisa sits on that list. I think Shein is the first serious competitor I've seen for Lovisa.
I would also say that this isn't just brand competition. There's been a nationalistic shift in China, I think, over the last 10 years, where they want the consumers themselves, Chinese people themselves, want to support Chinese brands in the face of Western competition. And Chinese companies have responded to that. Their marketing has improved, the quality of their products has improved, and they're very good competition for Western brands. And I wouldn't underestimate their ability to continue with doing that and challenge these Western brands. So I agree. I think there's more risks in that area than what most people are think there are. We're going to take a short break. When we come back, we're going to talk to Nick, who owns the iShares China Large Cap ETF, and we're going to collectively discuss the risks in doing so.
Think investing is out of reach? Think again. Fund Later lets you own a $10,000 portfolio with just $4,000 up front. Fund Later will lend you $6,000 to fast-track your investment journey, and you can repay it in monthly installments that include a facility fee. There's no waiting, no margin calls, and you can choose from 3 professionally managed portfolios. And here's a bonus. Open and fund a Fund Later account in January or February, and you'll get free access to InvestSmart's online bootcamp course, valued at $99 to sharpen your financial skills. Visit fundlater.com.au to learn more. Terms and conditions apply.
So, Nick, you own the iShares China Large Cap ETF. I'm encouraged to buy some. I don't know what Gaurav thinks, but you've done that. You know the risks. Can you sum that up for the listener and tell us how this might go wrong?
Yeah, I think I just state to start off with, this is a very small position, so you've got to be very careful about your position sizes. And that's because of the risks. And I think the 2 biggest risks that make China, why people think China is potentially uninvestable, are the sort of frozen asset risks. So if the standing with West was to deteriorate to such a point that we cut all economic ties, you might not be able to get your money out of China, which is essentially means your investment is worth zero. And you saw that happen when Russia invaded the Ukraine. Russian investments essentially went to zero and you couldn't get your money out. I think that's a much lower risk than people probably appreciate. It sells headlines, it sells papers, but just the reality of us decoupling from China, it's pretty tough. I mean, Australia is, it's our largest trading partner. It's the largest trading partner for most countries on earth. So I think this is much harder than it looks. And then on the Chinese side, they need buying power for goods, and they still need foreign capital. So I think that decoupling risks is lower than people appreciate. The second big risk, I would say, though, is just the fact that China isn't a free market. There is elements of capitalism, and then as we've seen, that can change overnight, and you can go back to a much more authoritarian approach. And that pendulum tends to swing over time. I think it's swung a long way the other way towards sort of that old Mao-style Soviet Union communism. And I think the government, as I've said, is putting in place measures to swing the pendulum back. But that is a risk, and that's why I've sort of chosen the iShares product that has 50 companies rather than just betting on Alibaba that might come under pressure. I think that diversifies that risk a little bit, but it's no doubt it's a risk.
Yeah, no, I would never invest in just one Chinese company.
2's are okay though, right?
No, I think the only way to invest in China is through an ETF. I mean, if the CEO says the wrong thing, I don't know, gives the wrong hand gesture. I mean, the law and order is so indiscriminate in China. We don't know what could set the government off, and you get people arrested or random bans in place. You cannot rely on the rule of law in China. And so for that reason, I would never invest in a single business. But an ETF is the way to go. So I actually I got approval to buy IZZ as well, the ETF. I haven't bought it yet, Nick. And the reason I haven't, I think it's a solid idea. I think China is extremely on the nose and a fantastic contrarian idea at the moment, especially now when everyone is leaping into American tech stocks. That is the great thing to do now is to look where others aren't, and that's certainly China. But I have to weigh up buying an ETF against weighing up spending money on a business I know listed on the ASX much deeper and potentially getting better returns. I mean, an ETF is always it can generate higher than average returns, but it's never going to give you multi-bagging style returns. You're probably not going to generate 20% a year over a long period of time buying an ETF. You can do that buying the right business, and that's why I've halted. I've got a highly concentrated portfolio. I'm not sure I want to introduce an ETF into that, even though I think it's a pretty solid idea. And at the moment, we'll make a pretty decent hedge. So that's why I've paused. I haven't actually pulled the trigger, but
Gaurav's backing out. I'm going to give you more reasons to not to not do what Nick has. So if you look at the CSI, which is the main Chinese index, over the last 15 years, I think China's GDP has quadrupled. The CSI 300 index has risen by less than a quarter in the past 15 years.
Wow.
And I would say that all of the risks that we've discussed are the reasons for it. People aren't really changing their minds about China.
I think the coal dividends are higher than that.
Yeah, probably.
Yeah.
The word uninvestable came out from a JP Morgan Chase note in 2022.
Really?
Yeah, they called it uninvestable.
But
then, always aware of the money, they actually withdrew the note. Shit. We're going to lose a lot of cash from this. But obviously the term stuck. So it's quite possible that like stock prices are really cheap. That does not mean that China becomes investable just because stock prices are cheap. They've been cheap for a long, long time, as my experience with Alibaba and Baidu suggests. I keep looking at them and going, this can't continue, but it has continued for 6 years. It could go on for another 6 years.
The other thing to know, John, is that IZZ is an ETF of an ETF. So it's a second order derivative. So you don't actually you don't own the product. Doesn't own the underlying stock. It owns an ETF listed, I think, in Hong Kong, is it, Nick? But that owns the underlying stocks.
Yeah, I think it might be even listed in London too.
Maybe in London. Yeah. All right, but it's listed elsewhere, and that entity actually owns the underlying stock. So you're further removed from actual ownership of those businesses. That's the only thing. This means a little bit more risk and certainly more fees.
So let's close by saying that investing should be fun, and I think that's why I bought Chinese stocks.
What? Hang on, that's news to me. I thought it's supposed to be painful.
Well, it's that as well.
Painful and terrifying. That's my experience.
Yeah, it's definitely terrifying buying Chinese stocks, believe me. But there's something fun about it too. You get to learn about these businesses in a very foreign land, and it's sort of thrilling to see how these companies have grown over the years and what they're doing with them. I don't know whether this is a good idea or not, but I think Nick's right. This is not something you want to back with a lot of money. This is a small position, a speculative position, understanding that the whole thing could blow up, but it's quite interesting to examine. And it's interesting to discuss too, because China is a fascinating country, and it's going to be interesting to see how things develop there over the next few years. I want to just say thank you to our listeners, to StockTake. If you do want a free trial and read more about Nick's investment in this ETF, you can go to the website, www.intelligentinvestor.com.au, and sign up for a free trial and get all our recommendations that we have at the moment. And until next fortnight, thank you for listening. Thank you, Nick. Thank you, Gaurav.